Most people hear the term jumbo mortgage and immediately think one thing, a bigger loan with a bigger problem. But in 2026, that assumption is outdated because jumbo mortgages aren't just large loans. They sit at the center of housing affordability, interest rate trends, credit risk, and overall financial strength. And understanding how they work could save borrowers thousands of dollars over the life of a loan. Let's start with the data. As of June 2026, the average 30-year fixed jumbo mortgage rate is around 6.66%, with most lenders quoting roughly 6.7% depending on credit profile and down payment. For comparison, 15-year jumbo loans average about 6.1%. Jumbo refinance rates are around 6.8% for 30-year terms. And purchase jumbo loans typically range between 6.1% and 6.8% overall. Jumbo loans are defined as mortgages that exceed conforming loan limits set by the Federal Housing Finance Agency. In 2026, that limit is generally around $832,750, rising up to $1.25 million or more in high-cost housing markets such as California, New York, and New Jersey. Once you cross that threshold, you enter jumbo territory, and the lending rules change significantly. Now here's what surprises most borrowers. Historically, jumbo loans were more expensive than conventional mortgages, but today, that gap has narrowed dramatically. In many cases, rates are now comparable. In certain market conditions, they are even slightly lower because they are heavily dependent on borrower strength. To understand where rates are heading, you need to look at the biggest driver, the 10-year U.S. Treasury yield. Mortgage rates don't move directly with Federal Reserve policy. Instead, they follow long-term Treasury yields. When investors expect growth, they move money into riskier assets, pushing yields and mortgage rates higher. When uncertainty increases, demand for treasuries rises, yields fall, and mortgage rates tend to decline. That's why from 2022 through 2026, mortgage rates have generally stayed elevated in the 6% to 7% range, following inflation shocks and tighter financial conditions across the market. Since jumbo loans are not backed by Fannie Mae or Freddie Mac, lenders carry more risk, leading to stricter approval standards. In 2026, typical requirements include a credit score of 700 or higher, a debt-to-income ratio of 43% or lower depending on the specific lender's requirements, a down payment of 10% to 30% depending on property type and your overall risk profile, and cash reserves of 6 to 18 months of mortgage payments held in liquid assets. For investment properties or second homes, these requirements often become even more strict. So how do you improve your chances of qualifying? First, strengthen your credit profile. Higher scores improve offers. Second, reduce existing debt. A lower debt-to-income ratio signals long-term financial stability. Third, increase your down payment. More equity reduces lender risk and can improve your final pricing. Fourth, build strong cash reserves. Lenders want to see that you can handle unexpected financial shocks. And finally, shop multiple lenders. Jumbo mortgage pricing is not standardized. Different banks, credit unions, and private lenders can offer significantly different rates for the same borrower. Even a small difference of 0.25% in interest rate can translate into tens of thousands of dollars saved. Some borrowers also use discount points. Typically, 1 point costs about 1% of the loan amount. This may reduce the interest rate by around 0.25% depending on the specific lender structure. Now, should you even get a jumbo mortgage? The answer depends on your financial position and goals. For many buyers in high-cost markets, a jumbo loan isn't optional. It's the only path to home ownership. But it comes with responsibility, higher qualification standards, larger cash requirements, and closer scrutiny. So the key is not just qualifying, but ensuring it fits comfortably within your long-term financial plan. Because in 2026, the smartest borrowers aren't just chasing approval, they're optimizing for cost and resilience. And here's the bottom line. A jumbo mortgage is not just a loan size category. It's a reflection of your financial strength and how well you understand the current rate environment. Because in today's market, success isn't just about buying a home, it's about structuring the right mortgage behind it. And that decision can define your financial flexibility for years to come.